Welcome everyone to CSI Live. It's May 22nd. We're going to be talking briefly about analog devices. They have earnings later tonight, so we'll be talking about some expectations. And then we'll finish up with Snowflake. And then we have one pre-submitted question that we'll go over. And if anyone in the audience has any questions about these presentations or maybe what we talked about last night, Nebius and Palo Alto Networks.
Or Wix and Zoom. We didn't prepare presentations for Wix and Zoom, but I'm ready for questions if anyone's interested at all in either of those two software companies.
Okay. So here's our new end market cycle chart. I think we're just going to go with this now. Nick updated it just a couple weeks ago, but barring any further obstruction because of tariffs or trade wars, this is the path that we're seeing right now. At the top, of course, has been the biggest market, accelerated computing and AI infrastructure. It's possible that we're seeing a re-acceleration of growth instead of a slowdown. And then consumer and cloud and enterprise, both either in the midst of a growth cycle or as if you're cloud and enterprise at the start of a new growth cycle. And we have finally seen a bottom on auto and industrial. So we're now again at the beginning.
And that's where analog devices comes in. This is actually a very broadly diversified semiconductor company. They do a lot of design work. They have a couple of fabs around the world. They have little in-house manufacturing, so they are an IDM. But if you're looking at a clear signal for where we're headed in cloud, enterprise, and communications, as well as automotive, industrial, and a bit in power chips as well, sort of a power chip adjacent company, let's call it. Analog devices will be a key earnings report tonight. So this is sort of the expectation that we are at the bottom and we're entering a new growth mode. And you can see this reflected in the PE ratios. So in yellow, GAAP price to earnings on a trailing 12-month basis, about 72, but on a forward-looking basis, less than half. So that implies this expectation that earnings are going to more than double in the next year. Also, price to free cash flow there highlighted in pink, 35x on a trailing 12-month basis, about 27, 28 on a forward basis. Free cash flow, as you know, is lumpier, a bit harder to project into the future as a result, but still a sizable increase expected for analog devices. And the long-term growth rate, especially in the next 2 years, high teens percentage. It seems that we have begun to coalesce around this realization that maybe the semiconductor market, excluding accelerated computing and AI, is indeed at a new growth inflection point the second half of this year. So that's what we're going to call it. If you take a look at that updated end market cycle chart Casey just showed you.
And with that, we'll move on to Snowflake. It's been a year, I think, since we did our last presentation on Snowflake. April of 2024.
And this was the opening slide a year ago. Actually, I think it was the first one. Maybe we should hold off on that. I'm sorry, I'm getting ahead of myself.
Let's keep going.
Next slide. Okay, just a reminder, Casey, what does Snowflake have to do with the end market cycle chart?
Well, they're in primarily the cloud and enterprise portion of this in-market chart. And just as a reminder, we ended up buying some Snowflake in March. And then just 3 months later, March of last year, March 2024. And then 3 months later, we decided that we'd made a mistake and we promptly exited. And then as far as the end market, as I said, cloud and enterprise, Snowflake would benefit not just from AI, but that end market specifically recovering.
Yeah, and important addition there, also within cloud and enterprise communications networks. So that would be everything from like telecoms to internet service providers kind of included in that cloud and enterprise. Those are financial companies, sort of a type of communications business, if you think about it. All of those kind of embedded in there, and those are some of Snowflake's top customers. Okay. So what is Snowflake exactly? What do they do? Cloud and enterprise?
Yeah, they provide infrastructure software for data. And of course, we believe that data is the building block of the modern economy. That's down at the very bottom of our hierarchy of the economy chart there.
And so Snowflake, at least a few years ago, anyways, 5 years ago, really viewed as this very innovative and unique platform to be able to break down different data silos that companies have, across their very large enterprises. Some of it in the cloud, maybe some of it on-prem. How do you kind of pull all of that data together? And then they've layered on things like computing and other product services based on that data storage core that they built. There's obviously some competitors now in what they do, but still Snowflake, one of the leaders in this specific type of modern enterprise infrastructure software management.
Now you get to see a little investor timeline because Snowflake really hasn't been as great of an investment as it could have been. And we kind of boil it down basically in this slide and in the next that it really just boiled down to too many investors piling in and the valuation just getting way ahead of itself.
Yeah, so for most of this time, we've covered Snowflake since the IPO in 2020. We ultimately decided, we got access to it, the IPO via Salesforce and Berkshire Hathaway. In our particular case, we were good with that. And we've just kind of watched from the sidelines until, as Casey said, early last year, we decided to take a small position, realized maybe that didn't quite fit with what we were hoping it would be at the time, and promptly exited. And the reason, ultimately, what it boiled down to is the elevated competition for Snowflake, leading in part to their decelerating growth. And the valuation wasn't cheap and really still isn't. But we'll come back to that here at the end. So these were our valuation notes a little over a year ago. We'll, of course, put these slides if you want to review them yourself. What's changed? So the free cash flow per share in the bottom left has changed. Stock price is up after hours there in the top left. If you want, if this is an activity you enjoy doing, you can update these numbers. But really, the assumptions haven't changed a whole lot as far as we're concerned. So we're just going to leave it as is for right now. And if you want, hit us up with questions. You can do this exercise yourself if you'd like. Okay, on to quarterly earnings.
So they had a nice, strong Q1. They had revenue growth, 26% year over year, and strong expansion with existing customers, 124% net revenue retention rate. So very nice, strong quarter for Snowflake. But growth does continue to slow. You can see that in both of these charts, their product revenue year-over-year growth, but slowing growth on their product revenue on the right on a quarterly basis. But CEO Mr. Ramaswamy is doing a pretty good job of sustaining the overall momentum.
Yeah, of course, they've made a couple of acquisitions in the last year to help with that. So those are probably still in the very early stages of paying off. Let's get an update on guidance. So this is their fiscal year 2026. We're currently in the midst of Snowflake's fiscal 2026. The report was Q1. The reason for that is this fiscal year ends in January, this next January of 2026. So that's why it's called fiscal 2026, in case you're wondering. This was the outlook 3 months ago, and here's the update we got. They basically increased their revenue just a little bit, expected to be up 25% year over year on product revenue. That's the actual Snowflake product, and it excludes the engineering and services line item, which is typically very small for an enterprise software company. So anyways, expected 25% growth now, and they left the free cash flow margin expectation unchanged at 25%, which is good news, because if revenue is higher and free cash flow margin stays the same, that still means more free cash flow coming in on the year. But let's break it down just a little bit, because the free cash flow number actually was kind of messy in Q1.
Yeah, it was well below the full year guidance. And we've pointed out that some of the higher capex for some of the other computing infrastructure or computing software companies has been due to computing infrastructure or GPUs, but that's not what's going on with Snowflake. Snowflake has been optimizing their software stack, and their higher capex is due to new office space expansion. And rather than focusing on getting their own infrastructure, they're allowing some of their partners like AWS to manage the hardware side, and they're not spending as much on that.
Right. So this CapEx that lowered the free cash flow on a year-over-year basis, the purchase of property and equipment of 45 million in Q1, that's actually going to go away after this quarter for the most part. And so free cash flow is actually going to be much higher for the next 3 quarters, much higher than the 25% that they called out for the full year. And so that'll bring the margin back up to the expectation 25% for full year of the current fiscal year versus the 18% margin that they just reported last night or earlier tonight. So that's where we're at right now with the Snowflake free cash flow story, which brings us back full circle to valuation. Where are we at on valuation? The line is where we were headed into the report.
Yeah, the line is the trailing price to free cash flow at 65x. And then on a forward-looking basis, price to free cash flow 55 to 57x, around there, based on that updated guidance. So still pretty rich valuation, even after everything that has happened so far.
Mm-hmm. Yeah, and after the after hours increase, Snowflake stock up like 10% on this report. It seems Wall Street was pleased with the revenue increase on the guidance. Snowflake is now slightly outperforming our favorite tech ETF, VGT, Vanguard Information Technology ETF. That's kind of what we opted to be our catch-all last year, and especially this year. If we felt like a software company wasn't able to outperform that benchmark, well, why not just buy a high-performing ETF? So Snowflake on a trailing 12-month basis, now slightly outperforming VGT. And the one thing that would give us pause here, if we had to choose between one, Snowflake or VGT, is this valuation right here. There is still a lot of growth and margin expansion embedded in this valuation. So here we are 5 years roughly since IPO, and that original problem of too many investors crowding in at the same time, counting too many chickens before they actually hatched, it's still present. So for us personally, this is one that we're still not hot to go out and purchase. We're content owning Snowflake via VGT, Vanguard IT. Or if you don't have access to that, if you're outside the US, there's equivalents. If you look at the MSCI US Tech or MSCI World Tech indices, there's lots of ETFs based off of that underlying index. So that's Snowflake. A little bit of an intro on ADI earnings. Let's go to questions. Anyone have any questions? And of course, if you don't have any questions on Snowflake or the current state of semiconductors, also Wix, Zoom earnings. Hey, Thunder V, how would VGT score in a rule of 40? Is it possible to estimate? Well, let's take a look. Bear with me here. Let me just go to Vanguard's website for VGT. They do have average statistics for the companies that make up the portfolio. And I'm just going to actually here, let me put this in the chat so you can look at what we're looking at here on our end. So if you, let's see, where would this be? I thought they had a section on here with like average earnings growth rate. Maybe not. Yeah, that's stock performance. I thought it was on here, Thunder V, but I'm not seeing it. But what you would need is the company's average revenue growth rate over the last year, and then the average profit margin especially if you could figure out EBITDA. Okay, so the earnings growth rate is on here. It's at 28%, and that's over the last, I think that's over the last 12 months. Sorry, over the last 5 years. So if you scroll down to the section of the page I just posted in the chat to portfolio composition, and there's a little table that says characteristics, and there's a little table there, VGT, and the benchmark. The third line in the table is earnings growth rate. I suppose if you wanted to, you could substitute that and just do earnings growth rate over the last 5 years. And if you wanted to like really calculate this out, though, you could add up all the companies in here, especially the top holdings of VGT are a very, very large percentage of the total. Apple, Microsoft, NVIDIA, Broadcom, Salesforce, and now Palantir in there. You could kind of like just take those and like run average revenue growth and average EBITDA margin on those, and then you could calculate the rule of 40 if you wanted. You're absolutely right, though. The bar is very high for VGT. It's a fantastic ETF.
All right, I'll go to our one pre-submitted question that we have from Alex. Valuing mature companies using price to earnings or free cash flow is intuitive. Take the inverse to get a yield. A 20x PE implies a 5% yield, which can be compared to the
10-year.
10-year US 10-year. However, when it comes to metrics like enterprise value, sales, namely in SaaS or software as a service, there's no obvious reference point. 10x versus 15x EV to sales doesn't mean much without context. Is there a baseline or range threshold that's universally deemed acceptable? Or do you simply rely on industry peers or a company's historical multiples to gauge whether it's expensive or not?
Hey, Alex. Yeah, good question. Yeah, EV to sales or price to sales for a company that doesn't, and I think you mean here using those metrics because the company doesn't have any sort of reportable profit, not free cash flow, not GAAP, not IFRS, nothing. So you're kind of left with this. So price to sales or EV to sales, it's actually quite simple. You can just take the company's peer group and you can chart this out yourself pretty easily. You can see the higher the revenue growth rate, the higher the price to sales ratio. And that's about it. That's the functionality of it. And the market's pretty good at awarding a higher multiple for the higher growth rate. So like, let's say we have SaaS company XYZ. Actually, that's a bad ticker symbol now because that's now block. Ticker symbol, ticker one, SaaS company one, growing at 30%, and then company two, let's say growing at 60%, double. The company growing at 60% is going to have a price to sales ratio of, let's say, 20. And so the expectation would be the company only growing at 30% is going to be maybe like a price to sales of 10. Just a simple example. So it's just a comparative ratio is all it is. But if you're looking for a way to value these companies, let's say it is a SaaS business, like you mentioned in your question, your expectation should be eventually over time, the benchmark is minimum 20% free cash flow margin for a software business, minimum. So there are some investors that may choose to do that. And let's just say, even though the company's not profitable today, for whatever reason, usually it's because they haven't reached an adequate scale yet. They're not big enough. Let's just pretend that their revenue they generate today is generating a 20% free cash flow margin. And then what's the multiple on the business? You could do something like that because price to sales is, as you say, it's very imperfect. And the only context derived from it really is doing a comparative analysis, which is very limited in what it tells you. So there's another little trick. You could just play pretend and say, what kind of free cash flow would the company be generating today if it was running at a 20% margin? Because that should be your expectation for a company that is scaling.
Thanks for that question, Alex. All right, that was our last pre-submitted question. So if anybody in the audience has any questions, you can type them in the chat or speak on stage. It's a small audience today, so don't be shy.
And thanks for being here, everybody. glad that this time slot works out for some of you. Questions on Wix or Zoom?
What's Wix up to these days? Tell me.
You already know.
Tell me what Wix is doing. I threatened to axe Wix a few times in our portfolio. So tell us why. Tell everyone why you kept it.
Wix is what you want to happen to your software company over time. The revenue growth rate has slowed, 13% year over year revenue growth, but their free cash flow margins keep rising, and they're actually now running at a 30% free cash flow margin. So it's not going to be the fastest growing SaaS business or software business out there anymore, but a company like that is able to sustain more modest growth and keep margins on the rise, and then buy back stock over time. That's a pretty good deal. We're happy to hold. Zoom, on the other hand, which we did axe, that's like what you don't want to happen to your software business. 3% year over year growth. Margins are essentially remaining flat. Yes, they're buying back stock, but if we go back to using VGT as the benchmark for a software business for whether or not we should buy a software stock, as Thunder V pointed out, 28% earnings growth over the last 5 years is a pretty high bar, and Zoom doesn't clear the bar anymore. So that's what you don't want to happen to your software holdings, your software business ownership.
What we need is another pandemic.
What Zoom needs, maybe.
What Zoom needs. And Banker asks, are you familiar with NVIDIA's proxy vote? What's that about? Just got an email for it.
Yeah, and Banker, that is the annual meeting, NVIDIA's annual meeting. So as a shareholder, you're entitled to vote on what's been presented to you in that proxy filing. And so you can choose to vote for NVIDIA's board of directors recommendations, or you can choose to vote on any alternate proposals that are in there from shareholders. In most cases, if we're happy with the business as we are with NVIDIA, we oftentimes just parse through it really quick and opt to vote for whatever the board of directors has proposed. But that's what that's for. If you're a shareholder, especially if NVIDIA or any company for that matter, is a sizable portion of your portfolio, you definitely want to look at those filings, those annual meeting filings. It complements the annual report. There's a lot of really useful information in there. It's a valuable business update if you view yourself as an actual business owner versus just having a stock holding that you plan on jettisoning from your portfolio at some point. You probably don't care that much, but if you plan on being a business owner of NVIDIA for a long time, these reports are worth your time.
All right. Any other questions before we end this session? I see you typing, Thunder V. I'll wait. Okay. Thunder V said, I'm just checking Wix.com expected long-term growth in FinChat. It's negative. Have analysts got it wrong?
Huh. For long-term earnings growth rate, negative 3.4%. That is interesting. So what could be happening here, Thunder V? I see that too. Now the earnings per share forward 2-year growth rate is 19%, but the long-term growth rate is at 3%, negative 3. So what could be happening here? These are, of course, as you point out, based on Wall Street analyst expectations. There's maybe like one analyst. Wix is not like a very widely covered business. So maybe there's like one or two analysts that have a long-term growth estimate. And maybe one of them has like a really, really poor outlook for Wix.
Averages.
And so the average for the long term is negative. But the analysts that cover it for a 2-year period expect positive things. So that's probably what's happening. There's probably just not a big enough sample size there to use the long-term growth rate. So hopefully, yeah, these are goofy things. Sometimes it's just a matter of how widely covered a business is. And Wix is not a huge business. It's not Shopify. So it's not like there's 30 Wall Street sell-side analysts covering this thing. It's a much smaller number.
All right. Thanks everybody for joining today. Great questions, for listening to us talk.
We'll still be around the rest of this week. So
yeah, we'll see you. See you all around.
See you around on the Discord server.
Take care, everybody.